With Bitcoin's digital gold credentials in tatters, can it still act as a hedge against the upcoming recession? Over the past couple of months, Bitcoin has firmly established itself as a quintessential risky asset, with the cryptocurrency's bullish thesis deriving much of its utility from projections of future dominance. We've continued to hammer home Bitcoin's elevated correlation with the NASDAQ 100 index, which personally I disagree with. Once again, the reason I disagree with this is if I look at the traditional halving cycle, I would expect Bitcoin to be exactly where it's at right now, regardless of the recession. And regardless of inflation, regardless of the macroeconomics, I would have expected it to come down to previous all-time highs. The previous all-time high around 2018 in the beginning, around January, was around 21,000. So 21,000 is exactly what we expect from the traditional halving cycle of Bitcoin. So I completely disagree with this. I think that is still a question. I do not think that they should be trying to hammer it home that it has a correlation with the NASDAQ 100. I do think part of that could be essentially coincidence. That's how I feel about it, which reinforces the risky credentials and heightened volatility of the world's premier cryptocurrency. Against this backdrop, many investors are viewing the upcoming recession in the U.S. with trepidation. After all, if Bitcoin is now to be clumped in the broader risk universe, it stands to bleed should an economic downturn materialize in the world's biggest economy. Nonetheless, the reality is much more nuanced than this simplistic interpretation. The U.S. Bureau of Economist Analysts, the BEA, will unveil the first reading of the Q2 2022 GDP growth rate today, which we do have those numbers for. As per Atlanta Fed's GDP Now model, the U.S. economy is expected to have shrunk for the second consecutive quarter. The funny thing is that they're trying to tell us that that is not the definition of a recession, but I'm pretty sure historically it has been. Apparently, we're just going to keep changing, definitions so that political parties can stay in power, unfortunately. However, readers should note that the recession in the U.S. is officially declared by the National Bureau of Economic Research, which takes into account a host of factors, including the health of the labor market. Consequently, even if the BEA unveils a negative GDP growth rate print today, it is likely that the NBER will declare a recession given the still robust broader labor market. The risky asset universe in the U.S. is being impacted by two key factors right now. Throughout much of this year, the first factor mentioned above reigned supreme, hammering high beta, growth-focused stocks that derive much of their bullish thesis from the present value of future cash flows, and which stands to be discounted much more heavily in the environment of rising rates. The initial correlation between Bitcoin and such stocks was established as a result of synchronous liquidation waves earlier this year, where institutional investors dumped their Bitcoin holdings to finance margin calls on their own drowning positions. Now this mentality has been firmly established, leading to a persistently high correlation between Bitcoin and growth-focused U.S. stocks. Recently, however, as economic deceleration fears started to grow amid relentless interest rate hikes from the Federal Reserve, the market has flipped its narrative where the bad news is good news again. The rationale underpinning this narrative is quite simple. With the majority of economic indicators flashing the proverbial red signal, it is only a matter of time until the Fed abandons its hawkish interest rate path and loosens financial conditions. As for inflation, the view goes that the upcoming recession or even a prolonged economic deceleration would be sufficient to recapture this genie in the bottle. This, of course, bodes well for Bitcoin and high beta U.S. equities. Yesterday's FOMC meeting had attracted a lot of attention as investors eagerly tuned in to gauge any inkling as to the Fed's capitulatory mood, vice its hawkish interest rate path. Interestingly, while the statement that accompanied another baked-in increase of 75 BPS in the federal funds rate was quite generic, Jerome Powell did throw the market a bone in the ensuing pressure, noting that what? It would be likely appropriate to slow interest rate increases at some point. Powell also stated that any future interest rates increased will be data dependent. This proved to be music to the market's highly attuned ears, with equity indexes and Bitcoin all recording outsized gains in the aftermath. This brings us to the crux of the matter. Apparently, Fed officials believe that the strong labor market in the U.S. will allow the economy to sustain the rapidly tightening financial conditions, allowing inflation to autocorrect as the aggregate demand in the economy slows down. Should the reality follow this narrative, the risk universe, including Bitcoin, is due rip-roaring gains in the near future. However, consider a scenario where the inflation remains persistently high, aided by the consistently strong labor market. In this situation, the Fed's hands would be bound and the much anticipated easing will not materialize. An even more devastating scenario would be one where the inflation decelerates momentarily, allowing the Fed to pivot towards a dovish monetary policy, only to see inflationary impulse re-accelerating. And that is definitely the fear there. This brings us to the crux of the matter. Under a typical recession, earnings crash as layoffs sap the spending power of the U.S. consumer, leading to substantially lower equity valuations. In fact, the S&P 500 index typically retreats around 35% from its all-time high in a recession. Bitcoin, however, is a non-traditional asset, and as such, it does not have any direct linkages to the aggregate demand in the U.S. economy. Of course, fund flows play an important role in driving Bitcoin's price, but this is a second-order effect. Consequently, once the federal funds rate peak later this year, the tightening financial conditions headwind for Bitcoin and the wider risky asset universe will dissipate. Any recession that then materializes would provide Bitcoin the opportunity to disassociate with the persistently high correlation regime with U.S. equities, allowing the world's premier cryptocurrency to rebuild its credentials as viable hedging instrument. At present, however, we see no indication that Bitcoin is about to forego its torrid love affair with the growth stocks. Until the regime continues, the cryptocurrency would prove to be a futile hedge against macroeconomic shocks. The U.S. economy has contracted for the second consecutive quarter, fulfilling one of the most important conditions for a technical recession. However, as stated above, the NBER is unlikely to declare a recession given the continuing strength in the labor market. It remains to be seen how GDP report affects Bitcoin and the broader risky asset universe. So, what you are seeing essentially is big media starting to realize that Bitcoin does have the potential to break itself free from this particular scenario. And I think that it's one of those things where I think people participating within cryptocurrency, we can kind of see the broader picture because we zoom out on the charts and we go, okay, here's this, we expect this. Okay, this still the expected result is still taking place. What happens, on the next halving of Bitcoin? Do we see it go back up again regardless of recession, etc.? I mean, I think that there is a lot of potential here, though, in the next year or so for Bitcoin to show some pretty crazy strength, especially as we see, the GDP shrink and so on. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.